Good morning, everybody. It's nice to be back in front of the the camera again and to see everybody. I think we probably share everybody's frustration at how long the lockdown is going on for, and just hope that everybody's keeping well. As you can see, the last couple of weeks the hair's grown a bit longer and probably a little bit more shaggy, but hopefully the brain is still working. So this is really a follow-up to Robin's presentation that we released last week. Robin's presentation dealt with the case for listed property and more the financial planning aspect of it. And so this was really just a case study on two shares that we hold quite extensively in income-focused portfolios to understand where we're at and why we think that there's substantial value in some of these shares for those who are prepared to take that value. So we're really going to focus on Fortress and NepiRockcastle. So let's just start with Fortress, and this is a snapshot of Fortress's portfolio. So you can just really see that they have some SA retail, which is about 22% of the portfolio, logistics at 28%, and then SA industrial, SA offices, and other, that sort of combined 14% is essentially non-core. They are looking to gradually dispose of that and to sell that over the course of time. And then Fortress has a large stake in NepiRockcastle. So these two companies are pretty intertwined, and the reason why we're covering them together. And NepiRockcastle makes up 37% of the value of the portfolio. And so if you look at the targets on the right, Fortress has a strategy of increasing its logistics. It'll keep its SA retail, and the retail space is really focused on sort of rural centres, township centres, and sort of CBD/taxi rank sort of shopping centres. They've got one or two sort of more suburban malls, but it's relatively small. And then logistics is where a lot of their focus is on at the moment. And then you have NepiRockcastle, and then they'll have sort of a 10% allocation to new opportunities if they see something sort of coming along. So that's where they're heading to. So given that NepiRockcastle is such a big portion of the portfolio and so important in their lives, let's just deal with Nepi first. As you all know, this is just a little bit of brief history. I think most people will probably know this, but the little diagram on the right is basically a little map of where Nepi's portfolio sits. They started in Romania, and through the merger with ROCKCASTLE and obviously through their own growth, they have expanded into 9 different countries across Central and Eastern Europe, CEE. It's a portfolio of 91 properties, 6.5 billion euros, 2.1 million square meters of shopping centers across all those different countries, and expanding. Sort of the most recent countries added were Lithuania and I suppose Bulgaria. The financial metrics of Nepi are strong, and these have been reinforced over the last couple of days with trading updates out of the company. The loan to value is 32%. They have a vacancy rate of 2.1%. They announced last night that 45 or just under 50% of their tenants across their portfolios are trading at the moment. So it's not all doom and gloom. They have limited turnover rentals, so it makes it quite defensive, and that a lot of the rental is just base rental, it's not turnover based. And their cost of debt is obviously 2.4%, obviously a lot lower than here because it's referenced off European interest rates and not South African interest rates. So Nepi is a very strong company. It's got a great portfolio, it's got a great footprint, and it's got a very strong balance sheet. So let's look at the distribution history for Nepi. The top line there, the DPS in euros, just shows the growth over the last 5 years in euros. So it's gone from 35 euro cents per share up to 56 cents per euro cents per share. Apologies, over the last sort of 5 years. 2 lines down, you can then see the growth rate growing nicely. The growth rate has slowed down as the portfolio gets more mature, and it's now a much bigger company after the merger with ROCKCASTLE in late 2017. So that's why the growth rate is slowing down. In rand terms, you can see what the distribution's done in rands, and obviously the difference between the two growth rates is really what the exchange rate has done over the period. Now, the key question is what's going to happen going forward. As I said to you, NEPI put out actually a trading statement last night saying that just under 50% of their tenants are trading. Obviously all countries have different strategies. They operate in 9 different countries, but most of that area is busy rebooting. So there's no doubt that they will be affected. Shopping centres have been closed like here. Restaurants, entertainment offerings, especially cinemas, will take time to reopen, and some of those things still remain closed, and those are large draw cards for shopping centres, some of the entertainment offerings. So they will be affected. Some of the brokers that we deal with, and we've done our own sort of stress testing. We stress tested some key metrics, especially loan to value, interest cover. These remain well above thresholds, even under extreme scenarios. So if you are in a situation where your rental falls and you can't meet your debt, that's obviously where the concern is, and that's one of the reasons why listed property shares have been under so much pressure over the last couple of months. But NEPI's balance sheet is rock solid, and we have absolutely no concern over their balance sheet at all. So there's a general forecast that they'll have a 14% drop in rental for 2020, which leads to an 18% drop in distributable earnings per share. So you can see that number there, the red number in the table above. But furthermore, we're sort of modeling that things don't return to normal anytime soon. So just remember on the previous slide, I said that vacancies were 2.1%. We're sort of modeling vacancies rising to 8% over the course of 2020 and 10% in 2021. So a worse outcome in 2021 before gradually recovering thereafter. But even under that scenario, and distributable earnings will recover. If you look at the table above, it's going to drop to 46 euro cents, and then it'll gradually recover. Even in 2 years' time, in December 2022, distributable earnings of 56.1 cents on our forecasts are lower than where they were in 2019. So that gives you some idea of the pace of the recovery and what we expect. We're not expecting a V-shaped recovery at all and everything back to normal. We expect a gradual recovery over the next sort of 2 years. And then obviously the rand is important for South African investors. So we are using 18 Rand 50 for this year, 18 Rand to the euro for next year, and 17 Rand for 2022. Currently, the euro-rand exchange rate is at 20.1. So using 18.5 for this year is certainly conservative. But even if you look at that and look at those numbers, a 10% drop in, we don't expect NEPI not to pay income. That's the first thing. And we expect that maybe their distributable income will be down about 10% for the year, which is very, very solid under the circumstances and doesn't justify where the share price is trading at the moment. So let me just update you on where that is. So if you look at the chart on the left, you can see the NEPI share price. It starts off at 210 Rand. So just a little bit of background here, because that fall looks alarming. But in 2017, NEPI merged with ROCKCASTLE at 177 Rand 50 a share. That was the merger price. It then rallied over the end of 2017 to just over 200 Rand a share. And then in January, February of 2018, all the rumors started circulating about corporate governance, and the share came under significant pressure. All those allegations have since been disproved. There was not one thing that the company was found guilty of, but the share price basically has gone sideways for the last 2 years, with little dips here and there. And then obviously the last fall has been the COVID-related impact. And you can see the share price got down to almost 50 Rand a share and bounced back into sort of almost 95 Rand a share, and is currently at around about 80 Rand a share. And if we use our forecast and we look at the income yield, 2 years ago, NEPI was trading at a 3% dividend yield, which is low and reflected the growth that the company was achieving. Now, over the next three years, NEPI is going to deliver about 12% income growth, which we think is a superb income stream from a very, very solid company with very little balance sheet stress in this environment. And that's just how attractive it is. So NEPI, we're very comfortable with. We have no problems with NEPI. We know they are invested in shopping centres, and shopping centres have probably borne the brunt of the COVID-related 19 shutdowns. But countries are coming back online. People are social creatures. They like to go out. We're not saying that things are going to go back to normal straight away. It's going to go time. And yes, there will be a bit more online, and there will be some changes in habits. But we're very comfortable that the way NEPI is positioned, they will cater to those changing habits in terms of the mix of tenants in their shopping centres, the mix of entertainment, and how they react to that. So we think NEPI is very attractive. So what does this mean for Fortress? So let's just quickly understand a little bit about Fortress. Fortress has two types of shares in issue. They have A shares and they have B shares. The A shares have a preferential right to income, so that means that they get the first call on any income that's distributed, and they have a preferred right to any capital in the event that the company is liquidated. Furthermore, in terms of the way the A units are constructed, the income on the A units will grow at a rate of either 5% or CPI every year, whichever is the lower. So if inflation is 6%, then the income on the Fortress A's will grow at 5%. And if inflation is 3%, then the income will only grow at 3%. And then the NAV is calculated as a 60-day weighted average price. So the A units are actually essentially like a bond. They have very bond-like characteristics. They're extremely low risk. They have preferential right to distributions. They have a guaranteed built-in growth element to them. And they have a preferential right should the company be liquidated. The B units, therefore, bear all the risk. The B units obviously get the balance of any income, and the growth rate will vary. So in very good times, you want to be in the B units. In the bad times, you want to be in the A units. Earlier this year, Fortress put forward a proposal to its shareholders to simplify the capital structure into one class of unit. That has been shelved. The different sets of shareholders, the shareholders of the A units and the shareholders of the B units, couldn't find agreement on how to be compensated, and so that whole proposal has been shelved, and there's no intention to collapse the structure at the moment. So that's important. So if we just look at the A units and the B units in terms of the share prices, you can see, so this is really since Fortress was created in 2009, late 2009. So you can see that Fortress A's have gone from roughly 9 Rand a share up to 20 Rand a share, and basically all the way back to 9 Rand a share where they listed 10 years ago. So that's pretty stable, pretty predictable, and it's in line with the way the structure of the share is created. The B units started life at about 2 Rand, went all the way up to 40 Rand, so you can see the huge amount of growth that the B units can deliver. And they're now back at 2 Rand as well. So they've collapsed all the way back down there. So the A units, more predictable growth and much less volatile returns, and the B units, much more risky. And we believe, we've long believed that the A units are perfectly suited to retired clients and our client base. We have extensive holdings in the A units. We have almost no exposure to the B units at all. So this is where it gets a little bit complicated. I don't want to make this presentation complicated, but I just want to highlight two things. The first line shows the growth in distributions every 6 months for the A units, and this is every 6-month period, and the growth rate is a year on year, so it's comparing December to December and June to June. And you can see that the FFAs, the A units, have grown at a steady between 4 and 5% over the last 3 years, in line with what inflation has been. And you can see on the B units that the growth has been much more variable. It's been negative for the last 4 reporting periods, and that's because obviously Fortress has been going through some changes to their distribution policy. But what's equally important is how much is actually paid out. So the bottom part of the table, if you look at December 19, they paid out 1.7 billion Rand in income distributions, and 54% of that went to A units, and the balance goes to the B units. So just remember that A unit holders have a preferential right to the income. So what does that mean going forward? So Fortress is becoming more conservative. In the past, they've been criticized for distributing income accrued but not actually received. So, you might earn some interest on something and it's a book entry as opposed to actually getting the interest in your bank account. And this was especially with regard to the BE Trust, and it was one of the allegations that was raised in early 2018 when the share prices came under significant pressure. So over the last 24 months, the calculation of distributable income has become much, much more conservative, and more changes have now also been introduced. This is a little bit technical, but all you really need to know here is that they have become much more conservative in how they calculate distributable income. So it will lower the amount of income that is distributed. So you can see from the table on the right that in the let's just look at the 2020 column. In the 6 months to December, they paid out 1.69 billion of income to their shareholders. For the 6 months to June, the forecast for June 2020, their forecast at the time was that they would pay out 1.38 billion based on the changes they've made to how they're going to calculate distributable income. And so assuming that policy was in place for the full year, they would have paid out 2.8 billion versus the 3.3 billion last year, which is a drop of 20%. So that is in lieu, because they've got the two classes of shares, it's quite difficult to introduce something that treats both shareholders equally. And this is essentially making the policy much more conservative, and it's in lieu of introducing a payout ratio where you earn 100% of income, but you only pay out 80%. They've made changes to the way they're going to calculate it. It means that less income is paid out, more income is retained, which strengthens their balance sheet, and it ensures that the company can survive the toughest of times. So what does this actually mean for distributions going forward? Now, bear in mind that A unit holders have a preferential right to the income. That doesn't change, and that's enshrined in the memorandum of the company. So the A unit holders will keep on growing at inflation or 5%. Now, inflation is coming down, which is one of the good things about the whole COVID-19. Petrol prices have collapsed and inflation is generally coming down. So we forecast that inflation will be 4%, 3% over the next sort of 18 months, and then gradually rising to 4 and 4.5% towards the latter period. So the A unit holders are not going to grow at 5%, they're going to grow at the lower of 5% or inflation, which is inflation. And so that growth is what we anticipate. So where the interesting thing now comes in is that the A unit holders have to get paid before the B unit holders get paid. And we have made some assumptions. We've looked at Fortress, we've chatted with the company. Our forecasts in the table above assume that the income on the South African portfolio falls by 50% to June 2020, and then there's a gradual recovery thereafter. Just bear in mind, if you think of the maths, if something falls 50%, it goes from 100 down to 50, and then it grows by 20% in the next period. 20% growth on 50 is back up to 60. Just remember that you were at 100 when you started. So even though it looks like 20% growth is pretty high, it's just because of the base effect that it looks so high. We're actually forecasting a pretty muted performance from Fortress for the next 2 years. So if we make some assumptions and we slash the income, and this is 6-month periods, we calculate that distributable income could fall to just under R1 billion in June 2020. Remember on the previous slide that Fortress Management forecasted 1.38 billion of distributable income for the June 2020 period. But that was before COVID, and we have to take into account that things have changed. And then, as I said, there's a gradual recovery every 6-month period thereafter. What is obviously important is that the percentage of the income that goes to A shareholders, if we calculate what A shareholders are due, that will rise from 54% to 92% and possibly to 94% in December this year before tapering off as the growth starts to gradually normalize. And so and then we're obviously assuming that our forecasts for NEPI come through and they get their income from NEPI that we have projected. So once again, our forecasts for distributions in June 2022 are lower than where they are in December 2019, which just goes to show that we're not expecting a V-shaped recovery. We're not basing our forecasts on wild assumptions that everything's going back to normal. We're projecting a very slow and measured recovery. But the point of the slide is really that A unit holders continue to benefit from a low risk preferred rights with growth throughout the forecast period, even if the total income is not growing. And that's the unique structure of the capital structure in this company. So Fortress really has, Fortress A units really do have bond-like characteristics. They're very low risk. They have a bond-like characteristic in that there's almost a guaranteed income, but there's a slight growth element to it as well. And if you just compare the yield that so Fortress is now trading at below 10 Rand a share. The income yield on Fortress is now 16 or so %. If you compare that to the money market, which is the chart on the left, and the yield on the money market, typically Fortress was trading sort of in line with the money market, so the yield on Fortress was similar to what you would have achieved in the money market. And for the money market, we're using the JIBAR 3-month rate plus 150 basis points. That spread is now close to 10%. So you're going to get 10% more income from Fortress than you are if you put your money into the money market right now, with some growth over the next couple of years as well. If we do a similar exercise comparing it to government bonds and 10-year government bonds, again, 5% more income from Fortress than you are going to get from government bonds. And that's obviously per annum. It's not in total, it's per annum. So you can see the significant discount at which these shares are trading, and the amount of bad news that these share prices are discounting in the price. So just in summary, Fortress A units are defensive in the current environment. They are ideal for income-focused and risk-averse investors. The Fortress B units, on the other hand, are far more risky, and there's a small risk of zero income over the next 12 months. There is a chance that the income goes to zero, a small chance, but they are geared, and therefore if things start to recover, the share price of the Fortress B units will recover much more quickly than the Fortress A units. But that's for the more risk-tolerant investor. For Fortress A, which is really the focus of our presentation and where we hold a lot of shares for clients, the price is back at levels last traded in 2010, 2011, really almost when it listed. Under current growth assumptions, Fortress will yield 16.7% in June 2022. It's currently yielding about 15.5%. So that'll grow to 16.7 with the growth in the dividend over the next sort of 2 years. The income could still fall by a further 40%. So if the income fell by a further 40%, Fortress would yield the same as the current 10-year government bond. So you've got a price in an absolutely doomsday scenario for the income to fall a further 40%, and then you would still get the same income as you would get on a current government bond. That's the extent of the discount at which these shares are trading at the moment. And other metrics are solid, so you can't look at the income in isolation. Obviously, people are concerned about balance sheets and debt and how much interest payments have got and whether these companies are going to survive. Fortress is very solid. They've got one of the lowest loan-to-value ratios in the industry at 33%. Obviously, NEPI has a similarly strong balance sheet, so between the two of them, we really don't have any concerns on the balance sheet at all. It's one of the strongest in the sector, and they don't have any debt that matures this year. All the debt has been refinanced. There's really not a lot of pressure at all. So it really just the point of this whole presentation is to reinforce the view that we hold FFA, we hold a lot of Fortress A units. We are very happy to hold Fortress A units. We have no intention of selling them. And for those clients where there's capacity, we will be adding more. We don't want to go too overweight on NEPI and Fortress together because they essentially can be seen as two intertwined companies, and we don't want to have, in terms of our own risk parameters, we don't want to have massive exposure to any one group of companies. That's just sound risk management. But where we can add more for clients, we think this is a great opportunity to secure a great yield for the next sort of 2 to 3 years, and it really flows through to the rest of the property sector. And we might try and cast some further light on 1 or 2 other companies in the next couple of weeks. So I trust you've enjoyed this. As always, we're free to answer questions. You can email us or call us. Call your financial planner or consultant. We are still trying to work from home as much as we can, but the office is open, so please do engage with us if you'd like to. Just to finish off, we hope that everybody stays safe. We hope that everybody retains their sanity and keeps going through this very tough time. And we look forward to seeing you in person, hopefully in the not too distant future. Thank you very much.